Hello and welcome to another video from the Trader Guy at thetraderguy.com. In front of you is the Euro USD chart, and as you can see I have some lines drawn every 500 pips, and these are basic guidelines. As you can see, the pair does typically react quite well at the 500 pip interval, but occasionally there is an area that shows up that isn't at one of the 500 levels. And this showed up in the form of a gap, which has been filled. It should be noted that this gap has been filled from the weekend, just a few short days afterwards. But something very interesting happened during the session on Wednesday. As you can see, that we reached that gap again and pulled back a little bit. Now, at first, it looks like this pair could just power straight up. And the truth is this has been a very painful trade for those who have shorted the euro recently. I know I had a short euro position that was stopped out here over the last couple days. But looking at this, I started to notice some things. As you can see, the gap was filled, and it did kind of get you wondering whether or not it could continue. If you draw a Fibonacci though on the daily, you can see that the 50% retrace, which is a very common entry point for a lot of traders, is basically at about, say, 138.50 or so. Now, the thing about 138.50 is that historically I've seen that number from time to time. Looking at the weekly chart, you can see that it's been support there, resistance there, support there, resistance there. Turns out 138.50 is an area that Euro traders pay attention to. You can even make a spot there as well. So it has historical significance. And looking at the chart, if you draw this as a support area, we formed a little bit of a hammer in this area. Makes sense, and we bounced up to a major area. If this were a round number, it would probably be a little bit more obvious. So looking at the daily charts, the 50% retrace and that number, it's pretty interesting. Going at the 4-hour chart, you can see what's happened. We have formed a shooting star on the 4-hour chart right at the top of the gap at the 138.50 level. So it does look like we are at a serious inflection point in the euro dollar. Let's go ahead and take a look at why this move has happened. Well, it is in reaction to the belief that there is a solution coming in the EU debt crisis. Let us not forget that Merkel and Sarkozy met over the weekend and have decided that they were in fact going to come up with a solution in the next couple of weeks to a very complex problem. Notice how I didn't mention anything about an actual solution. It's because there isn't one, at least not yet, but the market has tried so hard to get ahead of this, and the market really wants to rally. The natural proclivity of the market is to go in the rally mode. And when I say the market, I'm speaking of the markets in general, not just the euro dollar, but I'm talking about the stock markets, futures markets, etc. So looking at all this, this is a part of the chart that's going to be very important for the euro. So far, it does look like the area is holding, although, anything can happen, obviously. And of course, if it breaks through here, one has to think that 140 will also give it some trouble. Let's not kid ourselves, though. Bad news could knock this thing straight down. Another chart that has caught my attention is the Kiwi dollar. Now, why the Kiwi dollar? Very similar setup, really. We have the 80 mark. Now, this is an obvious large number area. And you can see that it's been support, resistance, etc. over the recent history. The pair, when you look at it from a longer term perspective, it becomes a little clearer on the weekly chart that this was support, and we broke through support. We've come back up, bounced off support there, and retested it as resistance. Now the question is, will it hold? We don't know, but we know that these are the areas that we take trades at. When you go to the 4-hour chart, again, a shooting star butts right up against the 80 mark. The Kiwi dollar is highly sensitive to global economic news, and as such, really could accelerate to the downside if trouble is out there to be had and bad news appears. Not a real stretch as we haven't had any bad news over the last couple of days, so it kind of makes you wonder where it's been, because it seems like bad news is almost a daily occurrence. When you draw the Fibonacci retracement from the most recent extreme high, you get the 50% retrace just above the 80, so that makes it doubly, well, triply really, resistive, as it is the 50% retrace, the 80, which of course is a nice large round number, and proven support over the past. Now, some people would draw their fib from this level here. Well, that gives you the 61.8, the 80, and what was once massive support. It's pretty rare that we see all of these things line up like this, and they don't necessarily have to work. But what this does tell you is it tells you a couple different things. It tells you that there is real danger of the market falling at this point in time. And when I say the market, I mean the markets in general. It should be noted that the S&P did sell off towards the end of the day, and it is butting up against the 1210 level. I think at one point it was as high as 1220, and that's right about where you're going to run into trouble on that chart. The markets could sell off, or if we bust through these areas, it could be very bullish. Some very smart traders in the past have, and the name, there's an actual quote, I believe it's Jesse Livermore, but if I'm wrong, I'm sure somebody will email me to let me know, that did say that we are paying the market for information every time we enter a trade. If I enter in a short position here, and say I risk a couple percent or a percent of my account or whatever your risk tolerance is, and it goes against me and it goes up, well, what have I done? I've paid 1% or whatever of my account to find out what the next move is. If it blows through 80, we know that it's going to go higher because it's an area that matters. Of course, black swan events happen, anything can happen, but the odds are we are going to rise from there. If I'm correct, then of course I profit. But if I'm only risking a percent or two, I'm paying for a little bit of information to understand the general direction of the market, at least for the intermediate term after that, and can make that percent or two back relatively quick. By being patient and waiting for these larger areas, we get this type of setup. As a side note, I have opened up the educational forum at thetraderguy.com, and it can be found at the top of the front page by clicking Educational section. If you click on that, there is a little disclaimer that you have to read, and then you can go into the forums, and I have plenty of videos explaining how I trade. It's not the only way to trade, obviously, and I know some damn fine traders who can trade without using my techniques. However, it's what's worked for me. It's completely free, and it's just my way of trying to give back. Thank you for your time, and feel free to email me at chris@thetraderguy.com if you have any questions or comments. Thank you.